Welcome to Live Your American Dream, where we are all about helping folks to live out their American dream with financial freedom. You know, one of the things that I'm really passionate about regarding the American dream is homeownership. In fact, homeownership is for many families the bedrock opportunity to build wealth and get into that American dream that they're believing for and hoping for. You know, the American dream is really all about the idea of hope for a better life, generational wealth being built and passed along from, mom and dad, grandma and grandpa to kids. There's so many amazing stories over the years in the United States of America about families who've been able to build some kind of legacy. And I think that's really what it's all about when I hear the term American Dream. So welcome to the channel. If it's your first time here, we're super glad that you've jumped on and joined us. Would love for you to smash on that subscribe button, like this video, and hey, do me a huge favor. If this content means something to you, if it's relevant to you and helpful, please comment, please interact, and of course, please share this with at least 3 people who you know could benefit from the content. So let's dive right in. Today, we're talking about seller buy downs in 2023. As I record this, it is January 2023, and the real estate market has been in an interesting period of time over the last 12 to 14 months. We've seen a lot of shifts all around the country. Where I live in the Austin, Texas area, things are still definitely booming, lots of growth, but we've seen a little bit of a pullback. And that pullback, it looks like a normalization. Okay, so we're talking a lot about this to folks who are looking to buy homes right now at my company, Waymaker Mortgage. A lot of the real estate agents that we work with, we're trying to help folks see the real, actual data and what's really going on in the market. Because if you're listening to national news, you're missing it. They're telling you that we are about to go into a housing market crash potentially, and there's a lot of things wrong. Well, this is not really the content of the video, but I will tell you to set this up. We are not in a position of trouble in our country. In fact, inflation is starting to curb, and we're starting to see home loan rates come down. We hit, almost 8% for a conventional home loan rate back in September, October 2022, and now we're down somewhere in the 6s. We're going to talk about that a little bit today. But the bottom line is we are in a position where we are seeing opportunity in the market because prices are normalizing, things are cooling down. If you tried to buy a house anytime in the last year and a half, 2 years, prior to the last few months, you know that it was challenging to even get an offer accepted. Most homes were receiving multiple offers within 1, 2, 3 days on market. It was crazy. Now is an opportunity for both buyers and sellers to get what they want, to get it with peace through the process, and to be able to negotiate as they should be. What am I talking about? Well, mortgage interest rates going up in 2022 has simply been the cost of entry to a less competitive market for a buyer. For a seller, we're looking at, hey, how do I sell my home faster, still get top dollar, still put my family in the position I need to be in to succeed? Because most people selling a home, they're either taking that money and buying another one cash, or they're taking that money and they're putting it down onto the next home. So there's always a net that you need to get when you're selling a home. So what we're doing a lot of is helping to educate buyers and sellers to bring the two together and help them to see why it makes sense to use strategies like the one we're talking about today, the seller buy down. And if you've paid attention to my channel or any of our social, you've heard me talk about this a lot for the last year. So what does this really look like? Well, let's dive into it. A seller funded buy down, especially a temporary one, right? That it can temporarily reduce the mortgage payment for the borrower. This happens because the seller offers a credit that pays the difference between the full principal and interest payment and the reduced principal and interest payment. The seller only needs to provide the credit, and the lender handles supplementing the payment. So it's a seller credit used a little bit differently. Now, as we start to see the market normalize, one of the things I'm seeing a lot of is sellers being willing to give buyers a closing cost credit of some kind. Typically, the buyer can use that closing cost credit and direct the funds the way that they want to. They could use that to buy down their interest rate on a permanent basis. They could use that to supplement the cost for closing. They cannot use it towards down payment. And there are some restrictions, so make sure you talk to your local qualified lender about what those restrictions are. For example, if you're using a conventional loan with 5% down, which is a very standard type of loan, especially for a first-time home buyer, put that 5% down, Fannie Freddie conventional loan, you can only receive up to 3% in assistance from the seller, total assistance. You up your down payment at 10% down, and you qualify to receive up to 6% assistance from a seller. FHA loans are different, USDA loans, VA loans are different, and so are investment purchases. So again, get with your local lender. Enough on that. Let's talk about why this seller buy down thing makes sense. Because for you, if you're a seller watching this, you want your house to move as quickly as possible, and you don't want to drop price. What you would prefer to do is keep your net sale a little bit higher and give the buyer some kind of a credit to entice them to move forward on the home. You as a buyer, let's talk about that. Interest rates are higher than you probably want them to be. We got super spoiled, folks, with rates in the 2s and the 3s in 2020 and 2021. Now we've normalized. That's all that's happened, by the way. We've normalized. If you look at the rate data going back 40 years, a rate in the 6s is certainly not a bad thing for our markets. It's bad for us as homeowners, and I totally get it, but it's not a bad thing for our markets. It keeps things stable. So things are normalizing. Don't worry. We'll probably see rates start to fall again later this year. That's the projection. So let's talk about an example. I'm going to show you on my screen here a seller buy down calculator. Now we're calling this is a 2-1 buy down because it's going to apply for 2 years. So we call it a 2-1 temporary buy down. And here's the example, right? So the purchase price on this home is $350,000. The interest rate is 6125. Down payment of 5%, loan amount $332,500. Okay. And our payment, our principal and interest payment here is $2,020.31. So this is a pretty common purchase, especially in the area where I live here in the Austin, Texas region. This will get you kind of an entry point, first time home buyer type home for the most part right now. Now, if the seller offers a credit, okay, this amount can be applied to the buy down for the first, second, or even third year payment, kind of depending on that credit amount. In this particular scenario, we are using a 2-year buy down. Now, suppose that seller agrees to supplement the payment difference for years 1 and 2. The note rate on your mortgage stays the same. It's fixed for 30 years at 6.125%. However, because the seller provides the credit, what the lender is going to do is use that credit to make up the difference between the note rate payment of 6.125 and the reduced payment for the term of the buy down. Hopefully this is making sense. I'm going to dig into this a little bit further and just kind of help you to see and conceptualize how you can use a 2-1 buy down to your advantage as a buyer or a seller. So let's look at this information. Now we float down here and we see year 1, the buyer gets an effective interest rate of 4.125. So it's lowering the rate by 2%, hence the 2/1. And the note rate payment stays the same, but the buy down payment, so this is what the buyer's going to pay for the first 12 months, $16.1146. Okay. Well, this is your principal and interest payment. This does not include taxes and insurance, just to make sure we make that clear. It's written at the bottom. That's a monthly savings of $408.84 for 12 payments. Okay. Then year 2, interest rate for the buyer is effective at 5.125. Make the screen a little bit bigger so you can see it. So 5.125, note rate payment, again, same, because your note rate stays the same. It's a fixed loan, but your buy down payment goes up slightly to $1,810.42, reduces your monthly savings for the second 12 months. And so over here on the right-hand side, you see your annual monthly savings. And this number, $7,424.77, is the amount required from the seller to make this happen. That is 2.121% of the purchase price. That's the seller concession required to make this happen. And so that qualifies under the conventional mortgage loan guidelines for 5% down loan. This buyer's putting 5% down. They can actually receive up to 3% from the seller. So if this particular buyer we're looking at was able to negotiate 3% in seller assistance from the actual seller, then in that case, they would be able to apply that additional money to their overall closing costs. Now, you might be thinking, okay, how does this actually happen? Well, there's 3 things that are very important to make it happen. 1, you've got to have a qualified professional real estate agent who understands how to talk this through with the agent on the other side. So if you're a buyer, you want to make sure you find a buyer's agent and interview them. Ask them questions. Hey, have you heard about the seller temporary buy downs? Is this something that you can help me to negotiate. Are you able to do that for me? So make sure they're qualified to do it. The second thing, you need a qualified professional lender. I do recommend working with somebody that's going to interface really well with your agent. One of the things that we do at my company, Waymaker Mortgage, is when a buyer comes to us through a real estate agent, we make sure that that buyer, the agent, and our team are fully in the loop on conversation and strategy throughout the whole transaction. It makes it a lot easier. If a buyer comes to us, they don't have a realtor, we have a network of agents, we'll introduce them to one. Or if they come to us with a realtor, but we don't know that realtor, we're going to take the time to get to know them and make sure that the lender and the realtor are 100% on the same page. The other thing, or the third thing on top of that, is you've got to make sure that you understand when you're making these offers, what the financing parameters are. As I mentioned a moment ago, a 5% down conventional loan can only receive up to 3% in seller assistance total. So you've got to make sure that whatever you're agreeing upon fits those guidelines. Okay. Now, what I would like to do is walk you through this scenario on a dashboard that we use called a total cost analysis. So I'm going to go ahead and bring that screen up here. And this is our total cost analysis, seller buy down, temporary versus permanent. Okay. So I wanted to dive into this a little bit, and this was supposed to say spring 2023, but I forgot the 2023, so forgive me for that. We're going to do what's called a rent versus own comparison here, and the whole idea is I want to show you the difference between a temporary buy down and a permanent buy down with effectively the same amount of money coming from the seller. So, and you see column one here, column one, we are looking at a rent strategy. Okay, so this is just simply somebody who's purchasing a home in the roughly $350,000 range. They're probably paying in rent between $2,600 and $3,000 a month. It's kind of what we normally see. And our first strategy here that we're looking at is straight 5% down conventional mortgage loan. So you can see your purchase price at $350,000. So your down payment of $17,500, your loan amount of $332,500. These are the same numbers we went over back here on the buy down calculator, by the way. Same scenario. Okay, interest rate 6 1/8. Let's see, total payment. Now the difference here is I added in the estimated taxes and insurance. So if we look at our estimated payment breakdown, we see homeowners insurance estimated $100 a month. We see property taxes. Yes, they're high. If you're outside of Texas, it's probably like, whoa. But here in Texas, we're used to it. And then mortgage insurance, all right? Leading you to your PITI payment. That stands for principal, interest, taxes, and insurance payment, estimated at $2,767.01. Woo, that's a mouthful. Okay, so next thing I want to do is bring another strategy online, and I want to show you what that buy down looks like in this format if we do a temporary buy down. So here is our seller buy down temporary 2-1. And what's really cool about this is, let me see if I can increase the zoom a little bit. There we go. So what we're seeing here, okay, is with the temporary buy down, you can see your effective interest rate at 4 1/8. You can see your payment change, which is great. And you can also on this system see, okay, here's your rent payment. Here is your payment with the 5% down conventional. Here is your first year payment with the seller buy down. So there's a pretty big difference in your net monthly payment, obviously, for that first year. Now, another reason that I will reference why folks are quite interested in this temporary buy down is because we do have information from the top economists in the mortgage industry saying that interest rates are on their way down. Economically, again, as I record this in early 2023, we're headed into, or we are in, a recession. So that means interest rates are coming down as inflation comes down. And historically speaking, that always occurs. Okay. So if we go back to the total cost analysis, we can see that, let me scroll down here. Rent versus principal paid in the first 60 months. Guys, look at this. If you continue to rent at $2,850 a month, you're going to throw away $186,000, $187 almost, over 5 years. If you purchase a home with that standard 5% conventional, then you're going to build wealth to the tune of $22,619. That's principal paid, full ownership of that property for you. If you use this seller buy down, temporary buy down strategy, Look how great this is. You are building wealth to the tune of almost $42,000 over just 5 years. It is a powerful strategy. Powerful strategy. Let's look at net worth. Net worth in 15 years. This particular individual that we're profiling here, if this was a specific person, they started out with $25,000 in their savings account, and that was growing at an interest rate of 1% APY. Now, 15 years later, the 5% down buyer without any buy down, gosh, look, their net worth is $392,000. My goodness, 15 years later, the person using that temp buy down, net worth almost $439,000. Guys, it's a game changer, especially converting from a renter to a homeowner. All right, let's bring on one more strategy here and just kind of look at comparing and contrasting the difference. Give it a second to load. Boom, there we go. We've got our seller temporary buy down permanent. Now, you may be saying, Scotty, what is a permanent buy down? Well, it's very simple. You can take money and buy down your interest rate. So remember, we started at 6 1/8, and this is a permanent buy down. It's for the entire loan. It's not temporary. So for the 30-year loan, you can apply funds, sometimes called points, oftentimes referred to as points, to buy down your interest rate. Click on this more info tab. I can show you right here on the closing costs. So the points here, the cost is $8,312.50 to get to a point of 5.5% rate. Now, we look at the payment, and you see your monthly payment here, that's principal, interest, taxes, and insurance, is estimated at $2,634.57. And as we kind of dive into this a little bit further, we can see, again, our rent payment versus our 5% down conventional, our first year seller buy down payment. And then this is the, again, these are principal and interest, not including taxes and insurance. And if you click here on more info, it actually shows the full payment. But the bottom line is we've got our seller buy down permanent payment where we've taken seller funds and we have bought down the interest rate for the long term. So why would you do this? Well, some folks are in a scenario where they're like, you know what? I don't know that rates are going to go down. I want my rate to be permanently bought down. Great. This is a scenario where you can do that. Your wealth building over 5 years. Guys, look at this. Again, net worth, almost $400,000 over 15 years. And that's just simply withholding this loan and making your monthly payments. So I often say there are 3 ways that you can build wealth, and they all start with I. 1, you inherit it. 2, you invent something. 3, you invest. I think the statistic is something like 90% of those who have a net worth over $1 million in the United States have earned that through investing. Okay, so great if you inherit, that's awesome. You're probably going to want to invest that money anyway. But what if you start at 0? What if you're watching this and you're like, gosh, I don't even know if this is possible. I don't even have 25,000. Well, there's other programs out there to get you into a home. You've got to find a lender that's willing to help you make a way and make it possible. And then you get into that home and you make your monthly payments, and that's it. And literally by making your monthly payments, you are investing in real estate, and you can be worth almost $500,000 in 15 years just by making your monthly payments. And what's really cool about this is once you become a homeowner, you might get the itch to become a landlord, and potentially you take that home and you parlay it into an investment property, you buy your next home. There's so many different solutions and strategies for this, but what I really wanted to do is just kind of dive into the seller buy down aspect, temporary versus permanent. Back to this screen, just a reminder, note rate at 6 1/8, temporary buy down year 1 down to 4 1/8, temporary buy down year 2 down to 5 1/8, and it costs a total of $74.24 that the seller's paying for. And by the way, back here, let's look at our cash to close real quick. I'm gonna pull that up here and highlight it. So cash to close, okay. This is the money due at the closing table for this purchase. 5% down, straight conventional. Looking at just under $29,000 out of pocket. All right, seller buy down, temporary 2-1. And if the seller pays exactly what's needed for the buy down, you're pretty much neck and neck because they're just covering your buy down and your subsidy. And then on this particular one, the seller buy down permanent, we had applied the same amount of funds as the temporary. So the 74, 24, and 77 cents. And then that actually puts you at a little over $27,000. So, when you think about these options here, especially for somebody who's renting at roughly $28.75 a month, it's pretty much a no-brainer to become a homeowner. And like I said, if you don't have the ability to come up with a $25,000 or $29,000 payment, there are options available to help you get funds. So if you've watched this, if you found it useful, please share this with somebody, like it, subscribe to our channel. Live Your American Dream is here to help you grow your dreams with financial freedom. That's what we want to do. And I hope you found it valuable today. Hey, if you got questions, reach out to us. You can email me at hello@waymakermtg.com. Of course, you can send a message, comment, whatever, but we'd love to chat with you. I'd love to hear your comments on this. I'd love to hear if any of you guys out there have used this strategy to purchase a home recently. Before I close out, a good friend of mine just bought a home a few months ago. It was one of the first loans we did as the market started to turn, with a nice seller buy down that helped them to get into the home. They didn't think they'd qualify. We had some debt to income ratio challenges, but what's really cool is using the seller buy down, we were able to buy down their interest rate, solve the debt to income ratio challenges, and get them into a great home that's affordable. Again, thank you for joining me. I can't wait to see you next time. And hey, let me know if there's any topics you'd like us to cover. We'd love to hear from you.